All right, welcome back all. Welcome to the more than 100 participants and guests who have joined us for this next conversation. First, I want to express again my deep thanks to our first panel on labor and corporate governance, a moving and very thoughtful set of discussions there. And we'll now turn to the questions raised by our sustainable finance panel. In particular, with the threat from climate change upon us, investors increasingly are calling for public companies to provide disclosure of environmental risks and for our financial system to be protected from climate change risk. The question we'll be asking today are, what are the best ways of achieving these goals? The panel will be moderated by my longtime friend and colleague, Berkeley's Frank Partnoy. Frank, please take it away.
Hi, Rob. Thanks so much. I'm thrilled to be here. Thanks to both Rob and Ed for putting together this fantastic group to talk about economic policy. And I'd also just like to add my voice to the thanks to Marty Lipton, who's been such a great supporter of conversations at the intersection of law, finance, and policy over the years, and has been one of the first people to talk to me when I publish an article about shareholder activism or some other topic. So thanks, Marty. I hope you're watching. I'd like to introduce our three panelists. We have SEC Commissioner Allison Lee, who has been advocating for better disclosure of issues related to climate change, and just in the last few days had an op-ed in the New York Times on that topic. We also have CFTC Commissioner Russ Behnam, who spearheaded the report many of you likely have seen on systemic risk related to climate change. And we have Marilyn Waite of the Hewlett Foundation, who has been supporting leading research in the area. She leads the Climate and Clean Energy Finance portfolio at Hewlett. So we have three of the leading public intellectual voices on this topic, and many of you have read their words or heard their voices. If you haven't read the recent words, you should. And we're going to be talking about economic policy related to disclosure issues related to climate change and systemic risk. And this is going to be nuts and bolts. It's an exciting time in this area, and we're going to talk about the best ways of achieving these two goals. So my goal as moderator is to take you inside their brains and where they're thinking, where their heads are at right now. So I'd like to start off with this report. Russ, you've got consensus from 34 stakeholders. You've got 53 policy recommendations. You've got this big report. I was just looking at it this morning. It's very exciting. And I have one question just to get the conversation kicked off, which is, how did you do this?
Thanks, Frank, and hello to everyone. Quick, just thanks to NYU Law and the Institute for hosting, to Rob and Ed as well, and Frank for you for moderating. It's a good question, and it was certainly a tough effort, and I'll be brief in sort of answering really the key points to how we were able to get 34 very diverse stakeholders to agree to a really comprehensive report that covers the full scope of climate risk and the opportunities that we can possibly learn from for the future. There's really two kind of parts, I think, to that response. And the first, and I focus on this constantly, is the committee members. 34 very dedicated individuals and experts from a various number of institutions that represent either market participants or stakeholders, from banks and asset managers to exchanges, clearinghouses, data providers, environmental groups, and public interest, and academics as well. And these individuals were willing to volunteer their time and share their expertise on climate risk issues, and really talk about the work that they had been doing individually or individually as a part of a larger institution, which says a lot, because I think from a private sector standpoint, from an academic standpoint, and from a public interest standpoint, it's pretty clear that a lot of work has been done in this space. People are very cognizant of the risks that climate poses to the economy and financial markets. And this venue, this advisory committee that I convened, was really an opportunity to let these individuals share their points of view. I also want to recognize the chair of the committee, Bob Litterman, who some of the listeners might know. Bob's really world-renowned as an economist and a financial risk manager, and has been focusing a lot of his years on climate change, recent years on climate change, so he was key. The last thing I'll say in the sort of second part to the answer is, we first met in November of 2019. The committee did the bulk of the work on their own. I certainly convened them and framed the issues and discussed the sort of progress on a day-to-day basis. But I remember very vividly the first meeting we had in November of 2019, when we really kicked off the effort 10 months from the the final product that was released last month. And I laid out very clear sort of three things. There was a clear vision to what I wanted to accomplish. and I laid out sort of the principles and the framework for what the committee should consider and think about. There was trust there. I think there was an element of me making a commitment to them that I would stick with what I sort of envisioned as the future of the report and the possibilities that it had. There was a level of commitment to achieving the goal, but also understanding that we needed to be flexible, which in the end, if you look at a lot of the policy recommendations, the public-private partnership really emphasizes the need to be flexible and iterative, because climate risk and climate change is going to be constantly changing the data we learn and the information that we sort of digest. And the other thing is space, just giving the committee the space to sort of do the work themselves, privately, have very transparent conversations, be inclusive in terms of what they know, what they can share with each other, and really having a conversation to lift up the best ideas, to lift up the best concepts, and ultimately get to the point where we can have this really comprehensive document with the policy recommendations. So a combination of a lot of different things, but I certainly think the trust, the commitment, the vision, and certainly the work of the committee members and their willingness to volunteer really fed to the opportunity to get to where we are today with that consensus.
Thanks for that. Allison, you've been building a coalition as well, talking over a period of time about the issues related to pricing systemic risk. Tell us just where your mind is now in terms of where the priorities are going forward. And you'll need to unmute yourself.
Thanks. I think the big picture sort of takeaway that in terms of what needs to happen now, we need to get accurate information about climate risks, the impacts, the opportunities into the financial markets so that assets can be accurately priced and capital can be driven toward climate solutions. By some estimates, we're operating within a very short time frame. So the time to act is now, and that's the message I really am trying to get some consensus around. And I think the consensus that Russ's committee has reached speaks to the urgency of the issue in terms of our need to do this. We're starting to see this information be sort of pumped into markets in Europe, markets in the UK. We need to be doing the same thing here because we've got to price it accurately and we've got to drive capital towards solutions.
So, and Marilyn, I want to bring you in just in terms of thinking about these two main themes of the diverse coalition of interests and then the accuracy with respect to ultimately pricing carbon. These are two issues that have been front of mind for you, right? Have we accurately at least put on the table the full set of issues that we should be thinking about so we can dive more deeply into them?
First of all, thank you for having me this morning, Pacific time. And thank you to, I'd like to thank Commissioner Benham for launching the CFTC report, which I think is the beginning of this, of the United States' role in the financial markets and incorporating climate impact and risk and pricing it and acting accordingly. So I completely agree and concur with what has been said so far. I would say that the economic impacts of climate change are many times over what we've seen with COVID, what we've seen in the 2008-2009 financial crisis, and we do have a short window to act. And so it is imperative to get the carbon measured and get it disclosed and manage risk away from that carbon towards a regenerative society and economy. So we actually do have the tools we need today to get started. Each minute we do not act, yes, the data becomes more salient and it changes because the situation becomes worse, the impacts become more severe. But we know what carbon is and we know where it exists in the economy, and we know for every loan and every investment how to measure it. There is an initiative called the Partnership for Carbon Accounting Financials, PCAF, which is industry-led, banks, asset managers, asset owners, small institutions like small credit unions to very large Wall Street banks are participating and getting it done. So they are harmonizing the methodology for accounting for carbon across financial asset classes.
Okay, so can I push each of the three of you to just be specific? If we have this window of opportunity and we know what these measures are in terms of getting companies to report more and helping investors to understand more about climate risk, tell us specifically in the next few months, if you could just snap your fingers in terms of the specifics of measurements, what do we want to see? So we'll start with you, Russ.
I think, and this is a huge lesson learned from the report. There are many details to it. There's 53 recommendations, as you pointed out, as I mentioned, and they range from disclosures, governance, best practices, stress testing under different climate scenarios. The first recommendation is putting a price on carbon. So just following up on what Marilyn said, we cannot assess the risk. It is currently an externality that if we don't put a price on it, businesses, financial risk managers are just not going to price it into their calculations and transactions. If I would say, to answer your question, Frank, the number one thing that I think is a takeaway from the report, and we understand this, climate change is a global problem. It's not something that's unique to the United States. It's not unique to one geography or one part of the country or any part of the world. We have to act together with our foreign partners. And a lot of work has been done, specifically if we're going to talk about economics, obviously, but financial markets specifically. A lot of work has been done overseas by multilateral organizations, by individual countries, to identify the risk, to come up with policy plans and ideas. But ultimately, if we don't do this together, we're not going to address the problem properly. So I would think the first step, if I had a magic wand and said, what can we do tomorrow? Because a lot of the policy recommendations will require executive action by regulators and potentially with respect to the carbon price, congressional action. The one first step we could take that I think would raise awareness, would send a positive signal across the globe and really push the conversation forward is better alignment with international partners, sending them a signal that we care about this issue, that we understand the risks, and that we want to be a part of the conversation and also hopefully lead the conversation for the years to come.
So Allison, I saw you nodding there. So we agree on having the umbrella be as broad as possible, but can you help us understand specifically what you'd like to see in terms of companies disclosing specific information with respect to climate risk?
Well, I was nodding because a key part of what we need to see does need to involve international regulators, industry. I mean, it's a broad base of folks that we need to bring to the table. In terms of the specifics, that's not the kind of thing that comes, I think, from on high from regulators. We need to work together. We need to coordinate with domestic regulators, with foreign regulators, with industry, with the disclosures of the information and the users of the information. There's a lot of good work that's been done among various private standard setters, SASB, TCFD, some international GRI, a lot of good work that's been done there and a lot of overlap in those regimes. So to me, first step at the SEC, organize a task force, put together some of the work that's been done by these existing standard setters. There's a lot of overlap, maybe as much as 70%, and use that as a building block and a template to begin identifying exactly what needs to be disclosed. A lot of work has been done in that area, and a lot of companies are, already disclosing consistent with that. So we have experience with that, and we have experience with how well it works, whether it's actually getting the information to investors that they need. But again, first steps, task force at the SEC, pull together our international counterparts and our domestic counterparts and industry, take a look at what's already been done, the building blocks that are already there, and figure out where the best practices lie.
So Marilyn, I assume that you agree on this consensus building that should take place. Do you have any concerns about how we should assess the specific tools that might emerge from that process? How do we tell if the measures that emerge from this sort of broad approach that both Russ and Allison have described are the right ones?
So I agree that one of the first steps is to join the international community. There's the NGFS, the Network for Greening the Financial System, join the Chinese People's Bank of China, the European Central Bank, and others. So the Federal Reserve, that's a low-hanging fruit of a first step. In terms of how to assess whether the recommendations are going to actually lead to this transition that has to happen, I think it has to be transparent and accountable. So when you are regulating the entire financial system, especially the leading economy, it's important that you have the information you need to make those decisions and to set good policy. So I would stay away from black box tools where you don't actually know what's happening. You don't know what the inputs in or what the outputs are. Well, you have the outputs, but you don't really know what happens in between the input and output. So what is transparent? What is tools for accountability? And also, I think the iteration is important because there will be better and better data quality. Not letting the enemy, not letting the imperfect be the enemy here. And starting from somewhere, starting from the carbon, starting from what we know, and then agreeing to constantly improve and to have the various parts of the real economy come together also to provide that data. One example is in the mortgage industry, having Fannie and Freddie required some of that data when they are underwriting or backing some of the loans. That could be systemically transformative. And so I think getting all the components together to really drive better and better data quality, but starting from somewhere and committing to starting from somewhere is going to be key.
That raises an interesting question about the difference between disclosures related to systemic risk and disclosures that are uniquely associated with an individual institution. How should we be thinking about those? Are those categorically different? The report talks about both sets of categories. Russ, should we be flexible with respect to each of those, but should we be thinking about kind of interconnectedness and the kinds of systemic risks that we saw in 2007, 2008? Should we be thinking about those differently than individual risks associated with institutions? Or how should we approach that? Or are they all wound up in the same sort of same disclosures?
Sure. I would say they fall within a larger umbrella, but they certainly have to be siloed because I think from a regulator's perspective, and it depends what regulator you're talking about. If you're a markets regulator like the CFTC and the SEC, you have a very discrete constituency that you need to point to and a responsibility under the law to fulfill. If you're a prudential regulator like the Fed or any of the other banking regulators, you have larger prudential supervision responsibilities, systemic and stability responsibilities that you have to consider. So there are so many pockets of data that need to be cleaned and filtered, aggregated. We need to share with the private sector in a very deliberate but very careful way, understanding proprietary issues and concerns. But we need to really have a better sense, I think, definitely from a systemic standpoint, because when you pull the larger, and Allison can probably speak to this as well, if not better, is think about the number of issuers that are 34 Act reporting companies. And individually, they're certainly not going to pose systemic risk. But if you were to look at that data in the aggregate, if it was well-defined and common and shared in a transparent way, in the aggregate, that data could certainly send signals about systemic and stability risk issues that either the SEC could identify, FSOC, the Office of Financial Research within Treasury, or any number of the prudential regulators. And as well, these are lessons from 2008 all over again, right? And they're different risks. They're not housing bubble risks per se, but they're impending crises. To Marilyn's point, the pandemic is teaching us lessons about how crises affect financial markets. And it's easy to oversee and sort of not consider financial markets a key element of this issue. I say this often. We think about climate change. We think about energy production, human health, national security. You don't necessarily think about the economy, and you definitely don't think about financial markets, but COVID should be a lesson that we have to be thinking about all this data. We have to parse it, silo it, but certainly look at it in the aggregate. And I think Dodd-Frank, in creating OFR and creating FSOC, are the great tools that we can use as really a patchwork of financial regulators to work together, to use each other's data and discrete expertise to come up with larger macro understandings of the risk that climate poses.
And Allison, you've spoken very eloquently, including in your recent New York Times piece, about the role of the SEC in disclosure with respect to this broader issue that involves so many other people. Your perspective on this one?
So obviously you raise a couple of points when you think about the difference between kind of individual disclosures and how we would gauge systemic risk. One of them is, and Russ alluded to this, the SEC's jurisdiction with respect to disclosure only extends to public companies. what I would hope we would see if we were to get and establish a good regime in place is a lot in the private sector following suit. And I think that already we see a lot of voluntary disclosure because of demand from investors with respect to that. So we do need to think a little bit more broadly than just the public filing companies. But then secondly, it's not just investors that need the information, it's regulators, because regulators are the ones who need to have their eye on the ball when it comes to systemic risk. So we have to work through organizations that were set up for that exact purpose, like FSOC and the others, to do the best we can to get that information to the agencies and to the organizations whose job it is to understand systemic risk. It starts with the building blocks of individual disclosures, but it has to be considered in the aggregate, because that is how you can accurately gauge the threat to the system on a system-wide basis.
Marilyn, any thoughts about the distinction between individual disclosures and disclosures related to systemic risk?
The only thing I'll add is that it's important to look at the system beyond the individual institution. So for a long time, we've only looked at the institutions, the individual, what happens within your four walls as a bank or as an asset manager, a little bit through your supply chain with some scope 3 emissions work, but very little. But when you actually start to aggregate and look at the entire system, you really see that it has to be taken care of at a systems level, because climate is global. It impacts everything. It makes everything worse. And so by only looking at the individual institution, we actually will miss a lot of opportunity to invest in solutions, quite frankly.
Could I
Frank,
get
can I jump
Please,
in one
Russ.
second? I think it's
Yes.
worth not clarifying, just sort of building off of something both Marilyn and Allison said. And Allison built this really nicely into her op-ed earlier this week. And the report talks about this really exhaustively, is the materiality standard. And I think that's worth noting for your listeners within the context of disclosures and data and information. The SEC has a decades-long materiality test, but and Allison pointed this out really well, is how are we going to look at materiality within the context of climate risk? And does the existing system of materiality really consider climate risk as it should be in both the short term and the long term? And climate risk is very difficult to identify. It's not linear. You can't really necessarily rely on past data, which is what a typical sort of financial analyst might rely on for future earnings of a company. There's so many different elements that sort of climate risk and what may come in the future that I think the argument goes, and I would love to hear from Allison on this, but based on what she wrote and what the report says and what I've studied, is you have to have a very different iterative sort of understanding of climate risk to better understand it. And it has to be clear and certain, because each individual, whether it's a public company or registered financial institution, will have a very discrete and unique sort of understanding of what climate risk is to them, as opposed to what it is to the larger group of institutions that are either regulated or issuing equity or debt and whatnot. So that's why I think it's really incumbent to come up with new ideas and new frameworks and new matrices for what is climate risk, so it's clear, it's understandable, and it's common. And as regulators and as investors, we then have better information to make more informed decisions.
Allison?
Yeah, I agree. Obviously, the idea that we have this kind of broad-based concept in the securities laws that says if you have, you must sort of broadly disclose anything that's important or material to investors. There are certain areas where we've had to understand that we need more specificity, and climate risk is certainly one of those. We have, for example, a very specific regime for disclosure around things like executive comp, because of the significance of executive comp to the broader economy and to how well it works. Same thing is true with respect to climate risk, and the sort of broad-based materiality standard I don't think is getting the job done with respect to climate risk. And I'm not alone in that assessment. Certainly, the sort of overwhelming demand for voluntary additional disclosure by really sophisticated investors speaks to that pretty clearly. So, but the tricky part, as Russ alluded to, is figuring out how, in particular, to help companies understand how to make forward-looking risk projections using scenario analyses and the like. And so that's the kind of thing where we need to collaborate, but we also need, I think, as Marilyn alluded, an iterative process and some open source information on that. I think the UK is working on putting out sort of some open source models for different types of scenario analysis so they can learn from that. But we've got to be able to give them a guidepost that's much more specific and clear and understandable and usable than just tell us about it if you think it's material.
And when all three of you talk about specificity and clarity, could you give us a sense of how you're thinking about metrics versus narrative? What role will rankings or numbers or quantified assessments of forward-looking risk play as opposed to narrative descriptions? And we've learned a little bit from ESG generally about metrics and the correlation of metrics. Can you help us understand this sort of where we're likely to be headed and where you'd like us to be headed in terms of specific measures versus more general or narrative description? So let's start that one with Allison.
Sure. So you know, metrics, there's a lot of work done out there on what metrics we need. Greenhouse gas emissions, obviously, and expanding all the way through, as Marilyn referred to, Scope 3 emissions and what kind of greenhouse gas emissions are you financing. So the metrics are really not necessarily the toughest part. The piece about how management is assessing its own risk, the narrative that you refer to, is critical. It won't provide the kind of comparability that investors need. Investors need to be able to compare how companies are performing. And so metrics are especially useful for that. But it's not enough on its own, nor is the narrative piece. The narrative piece is what helps you see the issue through the eyes of management, the company that you're investing in. How are they understanding it? How are they dealing with it? Do they have a risk committee of the board that is focused on this? Do they have a chief officer who is focused on this? So the narrative piece works hand in hand with the metrics piece. Neither is sufficient, in my view, on its own.
I'm going to play the moderator's role of just pausing and being quiet and letting the three of you have a conversation about this one.
I'll jump in there. And I want to emphasize one thing about the narrative specifically, because I agree with everything Allison said about the matrix, and certainly it needs to be developed and it's going to evolve and we need to work on it. But these are many of the things she mentioned earlier about work that's been done by different private organizations or coalitions of them that we as regulators in the public sector can work off of. Certainly there is a role for the public sector. I can't let this panel go without mentioning that, and I think most of the viewers will probably agree with that. But for those who don't, and I know there are plenty of people who, you know, question whether or not the public sector should get involved heavily or at all, but this is a problem of the commons. We need to work together. There are certain unique powers of the government that are both, if used well and in a disciplined way, can sort of lift up the country and the economy and people as well. And this is certainly an issue that I think we need to leverage the public sector's role to work with private sector. The narrative, and this is what I want to address, there's another narrative about climate change with respect to the global challenge is, okay, you know, if we take these steps domestically in the US, that's fine, but what does it mean for other countries who are not necessarily going to take those steps? If we're hinging or sort of disrupting economic activity and growth by whether it's putting a price on carbon at you know, the extreme level, which I support, or even taking any number of other steps to sort of address climate risk, are we then putting ourselves at a competitive disadvantage to other countries across the globe who don't necessarily take the same actions or believe the same things we do about climate risk? And that's a challenge with the narrative, especially with a public company, but other registrants as well in the financial spaces. You're leaving it on the management, the executive team, to sort of detail what they view as climate risks. And I think naturally they're going to err on the side of caution because they don't want to put themselves in a disadvantaged position relative to their peers or other public companies that investors may allocate capital to. And I think it's a lesson that one, this is why you need the public sector involvement to set standards and to be very clear about what is required, what information needs to be disclosed, and how you need to assess that specific risk. And then the other element, and this goes to the larger global issue, is we all should feel compelled to take a lead. You know, I think as a country, we should feel compelled to be leaders in this space. We've done it for decades on any number of issues. And I think this is a perfect example of where we need to step in, demonstrate leadership, and really lift everyone up, as opposed to, you know, the contrary of a race to the bottom, thinking that if no one else is doing it, why the hell should we do it? So difficult issues, definitely narrative is built into it, but this is why I think it's important that the public sector help support, you know, baseline foundations for what needs to be reported and disclosed, but also just as a general matter, how important it is, I think, for us as a country and, you know, practitioners in the financial services space or philanthropy to start lifting others up and sort of guiding the light in the direction.
Let me add, oh, sorry, go ahead.
No, go ahead, Allison. Go ahead.
One just really brief point is on the narrative. So, you know, one advantage of the narrative is it does allow companies a possibility to explain their metrics, right? They can come in and say, here's the metrics that I'm presenting. Let me explain to you how I view them and why. And it's just not to draw a comparison again to executive comp. We have something called the comp discussion and analysis. So they have all these numbers that they have to put out there, and then they explain, here's our thinking around this, here's why it looks the way it does. So it's true that there can be competitive forces at play when they're trying to figure out how to draft these narratives, but it also does allow them an opportunity to really sell their vision. And I think companies will, you know, will appreciate that when we get to that space.
Agree, and there's always context around the numbers that's important for financial decisions. But speaking of narrative, I would say that carbon is always material. So if you are sitting in California, Washington State, Oregon, Louisiana, you know that carbon is always material. We still have not ceased the wildfires, which are exacerbated by climate change in the American West. So that is part of the power of narrative. Although we do use the numbers and we need the numbers for the analysis, we are narrative-driven people. We learn by stories. Our brain works in a certain way around narrative, and that's important. And part of the narrative is climate change makes everything worse. It's systemically important, and that carbon is always material.
Some of the questions in the Q&A and some of the questions I've heard from many experts in the area revolve around the unintended consequences or the potential unintended consequences of a move towards disclosure or some of the other issues that are advocated in the report. It's hard to think about unintended consequences. They're unintended, right? So the three people we have here as experts aren't intending any negative consequences from any of this. But since you've all three been so deep in these issues for a long time, can you help us understand a framework that we might use for thinking about what unintended consequences might be? How should we be wary? Have we learned lessons from the financial crisis about potentially unintended consequences associated with some of the proposals you're discussing?
I'll start. I know both Marilyn and Allison probably have a lot to say on this, but from a report perspective and something that I had observed in the past, two clear things, right? Something that's very commonly used and has been used for years now when climate risk is discussed is transition risk, right? So we have certain embedded foundational elements of our economy. Well, let's talk about fossil fuels. We obviously have huge demand for energy production, and as we are transitioning to a net zero economy, how are we going to transition so that we don't disrupt both the current economy and people's sort of consumption of goods and services to keep the economy, you know, well and productive, but also understanding the risks if we don't transition soon enough before any number of target dates, whether it's 2035, 2050, with certain obviously temperature caps. So the report is very deliberate and very thoughtful about how we approach transition, understanding that we have to get to the end point, but we have to be mindful of the jobs, the stranded assets, i.e., you know, and again, fossil fuels being the most clear example is what happens if through technology, policy, or consumer preference, things change and, you know, assets in a portfolio and a pension then get depleted or you know, go down in value in a dramatic, quick fashion. The other thing I'll mention, and I know the others should chime in on this, and the report mentions this, is the very common and disproportionate effect that climate risk and climate change has on low to moderate income families and communities as well, and in rural communities or urban areas as well. And I think the report is very, again, deliberate, starting with the carbon price itself being fair, efficient across the board, and equitable, to any number of other recommendations to ensure that the unintended consequences don't manifest themselves in ways that would be disproportionately sort of weighty on low to moderate income families, as we've seen with climate already.
Agreed. So, you know, to start with, this idea of unintended consequences is why we need to have a regime that is living and breathing and is flexible. The science is changing, the effects of it are changing, they're changing in completely unpredictable ways. So we have to make sure that we stand up something that can move and change as the information we receive does, including, you know, sort of unintended almost by its nature means unpredictable, but including those. But Russ points out something that I think is extremely critical, which is that we have to keep our eye on the sort of potential impact that any solutions that we come up with may have disproportionate impact on low to moderate income families and areas and sectors and regions, that type of thing. That's critical. So we have to keep our eye on that ball. I think, but again, I mean, we have to have certainty that we have a system that we can change when circumstances on the ground change. This is an exceedingly complex problem. It's been identified by the Bank of International Settlements as something they call a green swan event. Which is just, you know, the complexities, they're non-linear, they're non-predictable, they interact with geopolitical forces. I mean, there's a lot going on here. So, you know, we have to be able to move and change if and as we see consequences that were not anticipated and certainly can be damaging.
I know we're focusing on a certain set of policy tools in this discussion, but it's worth mentioning that there are a lot of other policy tools that are very important in the financial system to drive inclusive finance for climate solutions. One of which is allowing credit unions to access secondary capital when it comes to climate-friendly lending. So enabling the whole credit union system, which are often close to low and middle income communities, especially those that are CDFI designated, to enable them to do this very low cost, affordable lending around electric vehicles, rooftop solar, energy efficiency, and what have you. So I think it's important to recognize there are a suite of tools that are important in the financial system to put in play for climate-friendly finance.
I'd like to just briefly dive a little bit more deeply into that, but first I can't resist just exercising moderator's privilege to make two quick points, one of which is a potential unintended consequence that was raised in the Q&A about who we're relying on with respect to providing information and some of the lessons that we might have learned from reliance on credit rating agencies with respect to assessment of risk. And the second, just the distinction between the capacity of the financial markets to assist with the pricing of risk for individual companies versus the substantive regulation that would require the internalization of those risks that might not come from the financial markets accurately pricing risk based on a company's cost of capital. So I'll just throw those out there. If you want to respond to those, that's fine. If you don't, that's fine as well. But I think Marilyn and really all three of you just raised a very interesting set of questions about who might be underrepresented as we move towards these kinds of assessments of climate risk. And so in the same spirit of talking about tools and specifics in the upcoming months about what we do, what can we do to ensure that the potentially underrepresented groups are at the table? Russ, you had a number of them at the table in your coalition. Can the three of you help us talk through, just in terms of specifics, what we should be doing to ensure that we have a diverse representation in this debate as it happens in the next few months?
Well, you know, I mean, from my perspective, if we're going to continue that, and we should continue having this debate, it's imperative to be inclusive, right? And this was something that was a priority of mine when I brought this group together, to make sure that we had as many points of view as those that wanted to contribute, so that we could understand the dynamics, a very, very complex dynamic of the American economy, how climate affects it, what risks there are, both intended and unintended, and how we need to react from a policy standpoint. I think from a regulator standpoint, there were a number of things about how we would and potentially could enact these policy recommendations. One very interesting thing was just starting with core research. And I know there's a lot of data out there right now, and a lot of research has been done about historical patterns that, historical policies that do disproportionately affect low and moderate income families and communities. And we have to learn from that. We have to have new data sets and new tools to research how a carbon price, or again, policies or regulations on fuel standards or renewable energy would affect different geographies. Obviously, this is so iterative and changing, but there are core procedures and practices that I think we collectively can take that would at least start the conversation, so that we can address these issues and not, have to look back sort of Monday morning quarterbacking and say, oh, we missed that, we missed that. But from a report's perspective, the members didn't go into specific detail about how they could or would specifically do this. It was more of a highlighting these issues as very unique problems that we've experienced in the past, and we do not want to exacerbate further on in the future if we continue down the path that we've taken thus far.
So at the SEC, I have advocated that we need to set aside a group within our Division of Economic and Risk Analysis, whose entire focus on every policy, all of our policymaking efforts, is on the potential effects on underrepresented communities. I think that's important. But with respect to this particular issue, when I referred to the need to potentially put together a task force, part of the so talent and expertise that we would want to recruit onto that task force would be people who can help us analyze and understand very specifically that issue. We need to keep our eye on that ball, and I think we can use some resources that we have internally right now with our, with OMRI, our Office of Minority and Women Inclusion, but we need to beef up those resources, and I would love to see us devote much more of a focus to that on all the policies that we do at the SEC.
It sounds very similar to one of the themes that emerged from our first panel about the need for representation on boards that includes both substantive expertise and kind of broad representation of a variety of constituents, but also kind of the specifics, in that case with respect to labor, in this case with respect to a number of other issues. Marilyn, you mentioned credit unions. Tell us about what else should we be doing, and would you just as an academic, and I know we have a lot of other academics on the call, and many of the regulators and corporate people who are on this, who are going to watch this video, are going to be thinking about what, from a research perspective, we should be trying to understand more deeply. Could you layer into your answer, if it's possible, your advice to us, what we should be focusing on in terms of this issue?
So I can tell you a few of the things that we've started to delve into in the past, literally few weeks, that are starting research projects. One is to have a lot more, the credit union sector has been overlooked in a lot of ways. So there are over 5,000 banks in the United States and over 5,000 credit unions. And we have evidence that clean energy loans, and especially EVs compared to an internal combustion engine auto loans, those EVs have a lower default rate. We need to have more research and evidence on that for credit unions, as we do for other parts of the financial system. So I would say more research and analysis into the business case, the investment case, the bank case for clean energy, for regenerative agriculture, so climate-friendly agriculture, and for clean transportation and all the other parts of the economy, including buildings, that are critical for reducing greenhouse gas emissions, and how that can impact the interest rates, how that could impact any kind of premiums for green lending or green investing, and likewise penalties for carbon-intensive lending and investing. So those are some of the aspects. Also, I appreciate the question on the rating agencies, and I think there's a lot more that needs to be exposed in terms of how that process is done and what are the underlying assumptions to ratings, and then how, you know, both historical but also forward-looking, we can have a more robust rating system that actually incorporates climate risk and impact.
One last oh, please, Russ. Please.
I'll be quick, but it's something that I've learned, and I think Allison can attest to this. In the past 3 years or so, crypto assets, Bitcoin, you know, people probably familiar with that, have become an emerging technology, and there's so much underlying it, blockchain technology, digital currencies. The reason I'm mentioning this is a lot of labs have sort of started within the federal financial regulatory system to sort of examine this new technology. And they're sandboxes. They're sort of, how do we engage with the new market participant? How do we think about issues? Sort of let's play in a little bit of a safe space and think about these issues. And I only mention that quickly just to say another tool, certainly that from the regulatory perspective, we could use to engage with academics, to engage with a private market and stakeholders to think about unintended consequences.
Great. Russ, I have one last quick substantive question for you, and then I want to give each of you opportunity to just have a last word. But many people have looked at recommendation 8.1 in the last part of your report and the relationship between fiscal policy and climate risk. So I'd just like to give you just a minute to talk about that so everyone's aware of that.
Sure. I appreciate that. You know, you look at the document, you know, the risk of climate change of the U.S. financial system, it's big, it's comprehensive, it's thorough, it outlines a lot of challenges that we're going to face in the coming years. And it's reality. We have to deal with it, we have to manage it, and we have to work together to get through it. But the final chapter, chapter 8, which is what you point to, Frank, and 8.1 specifically, is sort of a light at the end of the tunnel. It's the opportunities of what we're about to enter into. And I think as we sort of emerge from COVID and we think about some of the challenges the economy is facing, the relationship obviously between capital and labor and the unemployment and productivity, and what we need to do to build a resilient economy from infrastructure to technology, there are just so many opportunities. And 8.1 really specifically leverages the opportunities and recommends to policymakers and really Congress to utilize fiscal policy to invest through either pure straight investments or co-partnerships using the tax code to help support the rebirth of a 21st century economy. And those are my own words. Those are not the words of the report itself, but the stakeholders really think there's an opportunity for policymakers in the public sector to use its leverage and its power and the sort of the funding of the Treasury to invest money in a new economy through any number of tools, as I mentioned, like infrastructure and jobs. And I think there's a lot of things to look forward to as we build a more resilient economy as we deal with these climate risks. So it's an exciting, conclusive sort of part of the report, but one that I think people should care deeply about and think about, because there are so many different ways that we can spur innovation, keep technology in the US, protects national security, and really supports the productive economy for decades to come.
Thanks for that. And I see Rob Jackson lurking, but I just want to give Allison the chance to have a last word, and then Rob, I'm sure, will cut us all off.
Let me just say this. I think we're at a relatively critical point right now, because what we've seen is we're at a bit of a tipping point where businesses, private sector understands this risk, and they are trying very hard to respond to just bombardment of questions for information from all manner of sources, investors, ratings providers, index providers, and they're being a little bit overwhelmed. It's they've come up with this term called survey fatigue. But at any rate, in part because of that, and in part because of their recognition of the urgency of the issue, we've seen Business Roundtable just last week come out with a statement. Now is the time. Now is the time to bring everyone to the table and really start moving on this. So I think we've got a moment here, and I hope we're going to make the most of it.
Thanks so much to our panelists. I'll turn it back to Rob at this point.
Well, thank you, Frank, and thanks to our panelists for your deep, thoughtful discussion of this incredibly important issue. I want to thank my friend Frank Partnoy for his expert moderation of that discussion. My friends and former colleagues, Commissioners Lee and Benham, and of course, Marilyn, to you and your colleagues, your extraordinary leadership on this issue has been truly remarkable. Everybody, we want to give you a 10-minute break, give you a chance to grab a sandwich and prepare for our next conversation, really a highlight of the day. It will be Leo Strine, the former Chief Justice of Delaware, discussing the future of the American worker with Richard Trumka, president of the AFL-CIO. We'll see you all in 10 minutes at noon. Thanks.